Well, it's been an exceedingly frustrating week for markets all around the world, selling all over the place, crazy stuff happening, and those poor investors, us poor advisors, sitting here having to digest it all. So, hi there, everyone. Welcome to the Traders Circle weekly market update. Today is Tuesday, the 24th of October, 2023. And just before I get into it, and as always, you do need to be aware anything I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So the big news at the moment, obviously, is war in the Middle East, Israel, Palestine, Gaza. Essentially, obviously, we had the attacks coming out of Gaza from Hamas on Israel, and now we're seeing the Israeli response. Obviously, it's a massive humanitarian crisis. There's huge issues there. It sounds very callous when I start to talk about the market in response to these things, but it's a market channel. So the market is definitely worried about what's going on there. Unfortunately, not necessarily worried about specifically Gaza or southern Israel or whatever that happens there. I think it's more worried about whether the conflict spills over, whether we see further issues in, Syria, in Lebanon, in Iraq. Already we're starting to see Iranian-backed militias attack US bases throughout the Middle East. There's worries that, Hezbollah will take a greater role in the conflict, and that, all of these factors could lead to wider conflict in the Middle East, could lead to disruption of oil supply, could drag in US forces, could drag in the Iranian army itself, and could just basically spiral out of control and create a far bigger issue than we've got at the moment. And that's the biggest concern for markets. Now, unfortunately, it's very hard to say what's going to happen from here, but also, unfortunately, it doesn't look like there's a sort of easy, peaceful, non-violent resolution to this situation. Unfortunately, it looks like things are going to perhaps escalate even further. And that's, again, not great for markets. The Israeli government, Israeli army has been sort of suggesting they're going to do a ground invasion of Gaza for quite some time now. And though it has been delayed, it does look like it's going to happen over the next few days. In fact, already they've got elements, obviously, that have already started. And that's another potential flashpoint for markets. So this whole situation is not good for anything. It's certainly not good for markets. And unfortunately, in the short term, that doesn't look like there's going to be a resolution that markets will be happy with. Like I said, over the coming days, a potential wider scale ground invasion of Gaza, another potential flashpoint for markets. Moving on to something completely different, we've got the bond market. We've seen basically bonds fall very, very strongly in price. Yields rocket higher and higher. Australian government bond yields basically went to levels not seen since about 2011 over the past week. We saw our 10-year yield get up to about 4.85% before pulling back. Another higher peak there than the previous peak in yields. Overall, we've seen, especially the middle and later parts of the yield curve, push higher. And that's the market pricing in higher for longer interest rates, and perhaps even higher than expected average rates moving forwards. Now, obviously, the bond market historically has not been a good predictor of interest rates. No one has been, but it's certainly not what shares want to see. Shares do not want to see those yields continuing to push higher, and it's definitely contributed to the selling we've seen in shares across the past week. So it does look like bonds have sort of topped out a little bit over the last couple of sessions, both here and in the US, but it doesn't mean that they've finished on their move higher. We could definitely see bonds go to another level. For our own market, we could see 5% on our 10-year bond. That'd be a significant leg further higher than current. The US government 10-year has been bouncing its head into the 5% level. If that goes through, it'll be a technical breakout, and their yield curve should continue higher. So overall, although bond yields have been pushing up and at very high levels relative to the last decade, there has been a little respite for a couple of days. It doesn't mean they're just going to fall from here. That's something we'll be watching over the next couple of sessions. And for our own bond yields, the main thing will be CPI. So Australian CPI growth for the third quarter is going to be released at 11:30 a.m. tomorrow. That's 11:30 a.m. Australian Eastern Daylight Savings Time. I think 12:30 if you're in Queensland. Apologies, 10:30 if you're in Queensland. This is going to be the big one. This reading will likely determine whether we see another RBA rate rise this year. If it comes in as expected or slightly higher than expected, that's CPI growth, that means that we're probably going to see a November, but if not, a December rate rise. If it comes in lower than expected, that's where we might start to see people say, well, perhaps we won't see a rate rise this year. But as expected, I think they're expecting about 5.3%. That's still a very, very large amount above target. Target range, the upper bound is 3%, 5.3%. That's after, a bit of a slowdown already. That's way, way too high still. So 5.3% as expected. If it comes in around that number, probably going to see a November, but if not, a December rate rise. So this will be the big one. This will decide on the rate rises. It'll decide whether bond yields keep going up. It might decide whether our market, our XJO, our stock market rebounds or falls from here. And I wouldn't be doing too much until that reading comes out, 11:30 a.m. tomorrow. So let's have a look at the markets, at the charts. So this is the XJO, the top 200 stocks on our market. I'll just see if I can adjust this a little bit. All right, so we've basically been on a downwards move for the past really 3 sessions, Thursday, Friday, and Monday. We've stabilized a bit in today's session. We are setting lower peaks and troughs across the sort of past few months, and that is a bit of a bearish sign. We also broke through our yearly low support level at 6,900, and we've pretty much headed back to the next level at 6,825. So that level 6,825 would have to break before further selling looks likely, and then there's levels roughly every 100 points after that. If we break back above 6,900, I'd say we're likely to head back to 7,000. Like I said, again, it's probably going to come down to tomorrow's CPI reading, and I would expect to see some directional movement based on that. So it'll be either a break below 68.25 or a break back above 6,900. For the US market, they don't look quite as bearish. Yes, they've come off over the past week, but they've come back to a very key level, let's say roughly 42.20. That's also roughly where their longer term uptrend line sits, also roughly where the 200-day moving average sits, and it's a pretty good level to stage a bit of a turnaround. So we want to see whether the US market holds this level and shows a bullish bar, or whether it breaks below it. So in the short term, we've got the lower peaks and troughs, so if we break below it, that's going to indicate further selling. If we show a bullish bar from here, that'll likely indicate a move back towards maybe 43.30, 43.50 for the S&P 500. The key thing for US markets tonight will be their company earnings reporting. After their market closes, both Google, now called Alphabet, and Microsoft will report earnings. That's going to be a huge deciding factor over the movements for the next couple of days for US shares. So I'll wrap it up there, guys. That's it for this week. Hopefully you enjoyed. Bit of uncertainty in markets. Maybe they've found a little bit of a floor over the last few days, and I certainly am hoping that we can stage a bit of a bounce off that floor. If you enjoyed, click the like button, click subscribe, and we'll see you in the next one.